between the stimulators, Barack Obama, and the cutters in Europe. And that's raising some uncertainty, and we've seen that this week with global markets being significantly volatile and the New Zealand dollar coming off.
And we've seen it too with the British PM's new tough budget. He wants to slash 25% expenditure in the public sector. Is it going to be enough to save them from being another Greece?
I don't think that the Europeans have much of a choice, because their budget deficits are frankly out of control. The bond vigilantes, those in the bond markets who determine interest rates, are saying we don't trust these governments anymore after what happened with Greece. And so Europe, they don't have a choice. They're having to cut because the markets are forcing them. The Americans have a slightly more choice for now because they are still seen as a reserve currency, the world's biggest economy. How long that lasts is another issue. And I think we're in for a rocky period over the next couple of months as we see this tension between governments wanting to keep spending and markets saying, hey, that's enough, time to tighten your belts.
James, let's talk about Fonterra. Big vote underway among the farmers. Are they going to give the green light to outside investors?
Well, they're not. It's not outside investors into Fonterra. I guess that's the key point for farmers. I think they all understand sort of the outline of what Fonterra is proposing. I think it's going to be a good thing. Fonterra have said it's going to be their biggest. Since Fonterra was formed, it's probably their most important vote. So they're taking it very seriously, and it's going to take a lot of risk out of their balance sheet in terms of redemption. So.
And Fonterra have been quite careful to paint this as farmers not losing control of their cooperative. The last time they tried this in 2008, they were actually in a list completely on the stock market. This time they've got a bit of a halfway house where farmers can trade shares with each other and allow outside investors into essentially a unit trust, but not give up voting control or actual ownership of their shares to outside investors. So they have their cake and eat it too. They get some outside cash that can come in and they remove their redemption risk, but they still keep control of their cooperative, and that's why most people were expecting it to go through. We hear that some of the financial institutions may be asked to help with liquidity. Who might we be looking at? Well, some of the market makers could be the investment banks or the banks who are trading, the likes of the First NZs or the Goldman Sachs or some of the big trading houses. It will be interesting to see how liquid that market is, given that it's an unusual vehicle we're going to have. It's not a simple Fonterra shares listed on the stock market. There's going to be some disconnection between the actual investment vehicle and Fonterra, and mums and dads and pension funds may wonder about how this is going to work, and that will be the key measure. How liquid will this market be? Because farmers want a liquid market. But eventually a company like Fonterra is going to need outside money, isn't it? Aren't we heading that way longer term? Well, they hope they can get away with this halfway house, and Fonterra does need more capital over time. Whether or not investment funds decide to use this unit trust, this vehicle, this fund, is another thing, and whether farmers use it too to move in and out of Fonterra. But at least removes this redemption risk, which has been hanging over Fonterra's balance sheet for a couple of years now. The risk that farmers will jump out and sell their shares to Fonterra. Fonterra has to buy them back, and in fact could actually fund the creation of a competitor to Fonterra as farmers use the cash they free up from Fonterra to invest in new factories. OK, from Fonterra and farmers, let's go over the oceans now to Toronto, my hometown, where they've just had the G20 summit. What are some of the things that those world leaders have come up with that we should be aware of?
Well, I mean, I think, Bernard was talking earlier on about the G20 meeting and some of the changes. And when you look at the G20 meeting from 2008 and 2009, it was all about stimulating economies and stimulating those countries that were involved and making sure that was going to happen. This year, it's all been about cutting spending. So it's a complete U-turn in a lot of ways, and that has been forced upon those governments by what's been happening in the markets. So, I think there's been a general consensus that, government spending has got to be cut, deficits have got to be halved by 2013, and debts have got to be under control within sort of the next 5 or 6 years. That's a key point. There was going to be some more regulations. I guess there were some hopes around the banking sector, and that hasn't quite unfolded as much as people were speculating, and they're sort of putting that off a little bit for now. So, all of a sudden you've got a couple of people in Europe looking at cutting. The US want to make sure that we're still going to stimulate and not going to go into a double-dip recession.
And the important thing for farmers to watch out of the G20, as James is saying, is what's happening with banking reform. Before the meeting, people were thinking we might have banking reform globally from 2012. Now they're saying only starting in 2012. The key issue here is if banks are required to hold more capital and to hold more liquid capital and to be a lot more cautious with their funding, we could see the cost of capital, interest rates, and the availability of capital dry up somewhat globally. So it's not just a New Zealand issue, but globally. And that'll make it more difficult for farmers in the long term to get cheap, easy money from their banks and to have lots of credit coming through the system. And we've heard warnings from lots of banks that if we see a real tightening of these banking reforms quickly, then we could see a restriction on credit. So something for farmers to watch over the next couple of years.
Now, interesting, last week you talked specifically about the Chinese currency and that it was being partially floated, and yet in the final communique from the leaders at the Toronto summit, the Chinese didn't want any mention of this in it. What's behind that?
Oh, the Chinese are particularly sensitive about comments about the currency. Interestingly, they relented somewhat before the G20 and allowed their currency to float a bit higher and actually floated to a 5-year high. They have a very structured way they trade their currency. It sort of jumps up and down in very small movements. But it's clear that the Chinese do need to slow down their economy. And one way to do that is to allow their currency to float. That's good for New Zealand in the long run. And the trade situation with China is one of the really bright spots. New Zealand's exports to China have increased 140% in the last 2 years. The free trade agreement has been a huge success for New Zealand, particularly for farmers. Big increase in exports of milk powder. So it's good that the yuan is appreciating somewhat against the US dollar. That means it's appreciating somewhat against the New Zealand dollar. Our exports look more attractive, and consumers in China are feeling more wealthy and more likely to buy our exports.
All right. I wonder what the Chinese would think about the beleaguered Alan Hubbard. Here at home, South Canterbury Finance, this is a story that just won't go away. What are we up to with it at the moment?
Well, Alan Hubbard is currently in statutory management. It has caused a lot of grief in South Canterbury in particular, and real concerns for the South Island farming community, because South Canterbury Finance is at the heart of many lending arrangements for farmers in the South Island, and people are watching it closely. South Canterbury Finance itself, though, is not in statutory management, and we'll see in the coming week whether it gets an outside investor in, and it needs that if it wants to survive past the end of the government guarantee at the end of next year. I personally think that it's time for the government to look to wind up South Canterbury Finance. I think the risks for taxpayers, who are the ones standing behind South Canterbury Finance right now, are high if it's allowed to continue on past the end of next year. And it's one that farmers will be watching very closely. For Alan Hubbard himself, it's no doubt a very stressful time.
And then, of course, we come to May Wang. She's just been told that she will be giving back 2 cents on the dollar for her failed company. What do you make of that?
Well, she is really struggling to get through her deal to buy Crayford Farms. We've heard Landcorp is going to make a bid sometime in the next week for Crayford Farms at a lower price than May Wang's bid and the bid by UBNZ. It'll be interesting to see whether she comes out through the next couple of weeks without being made bankrupt, and whether the Overseas Investment Office will continue to look at that bid and whether it will be approved. I think the risks are that, for her at least, that it won't be approved, and that Landcorp, who have the money involved, will be able to raise the funds and no doubt have quiet government backing, will look to buy those Crayford farms on the Central Plateau and join them up with other farms they have there. It's a really interesting time, and the one point that I thought was interesting the last couple of weeks is that when the Chinese authorities came here, we had the Vice Premier come. The May Wang issue wasn't one that was raised. She and UBNZ are obviously not closely connected to the Chinese authorities, and that's good for New Zealand's relationship, because if she is blocked, it won't be seen as a bad thing for the New Zealand-China relationship.
Bernard, James, thanks so much. A really good and frank discussion. Okay, up next, we ask our guests, where to from here?